Hey guys, welcome back to the Bitcoin Fortress podcast. Today is Sunday, June 21st, 2026. We are at block height 754724. Moscow time 1560 sats per dollar. Current on-chain fees are 3, 4, and 5 sats per VByte. Thank you as always for joining me. If you're a returning listener, welcome back. If you're new to the show, this podcast focuses on Bitcoin, macroeconomics, personal sovereignty, sound money, privacy, investing, and building a strong foundation for yourself and your family in an increasingly uncertain world. This week felt like a perfect example of the environment Bitcoin was built for. We saw geopolitical tension in the Middle East. We saw a Federal Reserve that still refuses to fully pivot. We saw continued debate about Bitcoin treasury companies, miner stress, ETF outflows. We saw pension funds quietly begin dipping their toes into Bitcoin. And through it all, Bitcoin continued doing what Bitcoin does. Blocks every 10 minutes, no CEO, no central bank, no bailout, no emergency meeting, just blocks. That ultimately is the signal. And with that, let's jump into the news. First up, Bitcoin, Iran, and the Strait of Hormuz. Let's begin with the biggest macro story of the week. Markets spent much of the week reacting to developments involving Iran, the United States, and the renewed concerns surrounding the Strait of Hormuz. For those unfamiliar, roughly one-fifth of global oil shipments move through that narrow waterway. Whenever tensions rise in that region, energy markets immediately pay attention. Bitcoin traded lower initially before stabilizing around the mid $60,000 range. Now, this is an important lesson for newer Bitcoiners. Many people assume that geopolitical instability should automatically cause Bitcoin to surge higher. Historically, that is not how markets behave. The first reaction to uncertainty is often the same. Sell risk, raise cash, reduce exposure, figure out what is happening. Only later do investors begin asking deeper questions. Questions like, how secure is the financial system? How exposed am I to geopolitical risk? What assets exist outside traditional banking systems? That's where Bitcoin enters the conversation. What I find interesting is that Bitcoin increasingly gets discussed alongside gold, oil, currencies, and sovereign debt. That is a remarkable evolution. 15 years ago, Bitcoin wasn't even considered an asset. Today, it sits at the same macro table as the largest monetary assets in the world. The thing I will be watching closely is energy. If oil prices continue rising, inflation becomes harder to control. And if inflation becomes harder to control, the Federal Reserve has less flexibility, which brings us directly to our next story. The Federal Reserve remains the main event. The Federal Reserve held rates steady this week, no surprise there. However, policymakers continue signaling caution regarding future cuts. Markets continue hoping for easier money. The Fed continues saying, not so fast. This remains one of the most important stories for Bitcoin. In my opinion, the biggest headwind facing Bitcoin today is not regulation. It's not ETFs. It's not adoption. It's the cost of money. The entire post-2008 and especially post-2020 investment environment was built on extremely cheap capital. Money was effectively free. When money is free, investors chase growth. When money costs something, investors become selective. This helps explain why artificial intelligence stocks continue attracting so much capital. Investors can point to earnings growth and say, there's the cash flow. Bitcoin's value proposition is different. Bitcoin is asking investors to think 5, 10, or 20 years ahead. The market is currently rewarding shorter-term certainty. Bitcoiners are rewarding long-term monetary reality. These viewpoints can't coexist for quite a while. One thing I've mentioned before that I think is worth repeating: watch the 10-year treasury. The market increasingly cares more about long-term rates than overnight Fed policy. The bond market is becoming the real governor of the financial system. And that matters because the United States now carries debt levels that become increasingly difficult to finance at higher rates. That reality doesn't disappear, it simply gets deferred. Massive Bitcoin options expiry approaches. A huge Bitcoin options expiration is approaching at the end of June. More than $10 billion of notional exposure is involved. This matters because many Bitcoiners still underestimate how much derivatives influence short-term price action. Price discovery increasingly occurs through futures, options, ETFs, and institutional trading desks, not purely through spot buying. This means Bitcoin can move significantly in either direction even when nothing fundamental has changed. The protocol didn't change, adoption didn't change, scarcity didn't change, and yet price can still move dramatically. This is one reason I always encourage listeners to zoom out. Short-term price action often reflects positioning rather than reality. A large percentage of options contracts currently appear likely to expire worthless. That creates incentives for traders to hedge, unwind positions, and rebalance. So if Bitcoin experiences unusual volatility over the next week, remember, not every move contains deep information. Sometimes it is simply market mechanics. ETF flows continue to dominate headlines. Spot Bitcoin ETF flows remain one of the most important drivers of near-term market sentiment. Recent weeks have seen notable outflows from some funds, although the pace appears to be stabilizing. Now, I think it's important to maintain perspective here. The ETF approval was not the end of institutional adoption, it was the beginning. Bitcoin now competes for capital every single day against AI, against money market funds, against treasury bonds, against private credit, against real estate, gold, everything. That is actually bullish. Bitcoin has graduated into the arena. The key thing to remember is that ETFs buy Bitcoin because investors demand exposure. The ETFs themselves are simply wrappers. The real question remains, do investors want Bitcoin? And I believe the answer remains yes. The timing may fluctuate, the flows may fluctuate, the narrative may fluctuate, but the structural trend remains intact. Strategy remains one of the most fascinating financial experiments in modern markets. The company reportedly added approximately another $100 million worth of Bitcoin. Michael Saylor also hinted at additional purchases. At this point, Strategy has become something far bigger than a software company. It is effectively a publicly traded Bitcoin acquisition vehicle. The bull case is obvious. Continue issuing capital, continue buying Bitcoin, allow Bitcoin appreciation to compound, increase shareholder value. The bear case is equally obvious. Leverage, refinancing risk, market dependence, execution risk. I continue to believe Strategy is one of the most important companies for Bitcoin adoption, but I also think Bitcoiners should remember a critical distinction. Bitcoin and Strategy are not the same thing. Bitcoin has no management team. Bitcoin has no debt. Bitcoin cannot dilute shareholders. Bitcoin has no earnings call, and those differences matter. Bitcoin treasury companies keep multiplying. Following Strategy's success, more firms continue pursuing Bitcoin treasury strategies. Preferred shares, convertible debt, structured securities, yield products, the entire ecosystem is growing. This reminds me of earlier stages in other asset classes. Once investors discover something valuable, they begin creating wrappers around it. Sometimes those wrappers are useful, sometimes they become dangerous. I think Bitcoiners should mentally separate three categories: Bitcoin itself, Bitcoin ETFs, Bitcoin treasury companies. Each carries different risks, each carries different rewards, each serves a different purpose. Understanding those distinctions will become increasingly important over the next few years. As a practical matter, if you already own most of your net worth in Bitcoin, but you want to have some liquidity, you have choices. You can own a money market fund, but if you don't like getting 3 or 4%, you can always uh, invest in a treasury security, Bitcoin treasury security that pays a much higher yield. But of course, there's risk associated with that, as everybody learned over the past week with Stretch, where it cratered from $100 par all the way down to, I don't know, $84 or something like that. So you can take, you can incur losses in chasing higher yield, and that's certainly everybody's learned that in the space. But these, again, each has its purpose. So if you're just looking to diversify your fiat stack and earn a little higher yield, then maybe that makes sense for you, but you are taking a risk in that you might lose some of your principal. So again, heads up, be smart. And that rolls right into our next story, SATA, stretch, and the yield question. One topic many listeners have asked me about recently is Bitcoin-related yield products. This week, that conversation continued. Whenever yield enters the conversation, I immediately ask three questions. Where does the yield come from? Who absorbs the losses? And what happens during a severe drawdown? History teaches the same lesson repeatedly. Don't have to go back too far to see what happened with people that were trying to chase yield back in the good old days of Three Arrows Capital and all those fun things, and Sam Bankman, Bankster Fried, and all those other guys. Yield is never free. Someone is taking risk. The challenge for investors is identifying where that risk lives. These products may prove successful, some may fail. The important thing is understanding exactly what you own and why you own it. A Bitcoin yield product is not the same thing as Bitcoin. I actually, as I said earlier, think of it as a sort of a fiat derivative kind of thing, you know. And Bitcoin itself remains one of the few assets that requires no counterparty. Next up, Bitcoin mining difficulty falls. Bitcoin mining difficulty experienced one of the largest downward adjustments of 2026. Some commentators immediately interpreted this as bearish. I disagree. This is one of Bitcoin's greatest strengths. The difficulty adjustment is effectively Bitcoin's immune system. When miners leave the network, Bitcoin adapts. No emergency meeting, no central planner, no bailout package, no government intervention. The protocol simply adjusts. This is one of the most elegant engineering solutions ever created. Bitcoin's security model remains dynamic. The network continually responds to changing conditions. That resilience is one reason why I remain optimistic over the long term. And of course, as a home miner with my two little mining rigs, my little teeny tiny miners, I'm always happy when the difficulty adjustment goes down, because then maybe I have a better chance of finding a block. Who knows? Who knows? Could be. Might have to wait 1,000 years, but it'll be worth the wait. Miners continue chasing AI opportunities. Another major mining story involves the continued push toward AI infrastructure. Many miners are exploring high performance computing and AI-related opportunities. This raises an interesting question. What businesses are miners really in? Are they Bitcoin businesses, or are they energy businesses? The answer may be both. The companies with the best power contracts, best locations, and best infrastructure may discover multiple revenue streams: Bitcoin mining, AI computing, grid balancing, energy arbitrage. This trend is worth watching closely because it could reshape the mining industry over the next several years. Indeed, I think it's already happening. Pension funds quietly continue moving toward Bitcoin. One of the most important stories this week received very little attention. A Japanese pension-related allocation story highlighted ongoing institutional adoption. Notice what adoption actually looks like. It doesn't happen overnight. Nobody wakes up and allocates 50%. Instead, one fund allocates 1%, then another, then another, then another. And over time, those small allocations become meaningful. This is how institutions operate: slowly, carefully, methodically. The next major wave of Bitcoin adoption may not come from retail investors. It may come from institutions deciding that having zero Bitcoin exposure is becoming increasingly difficult to justify. Moving right along, the Clarity Act continues moving through Washington. One of the most important long-term stories for the Bitcoin ecosystem continues to be regulatory clarity in the United States. Of course, as you probably know, the rest of the world tends to adopt a lot of the things coming out of the United States in their own financial markets. So it does have a knock-on effect elsewhere in the world. Clarity Act remains a focal point of discussion in Washington and throughout the digital asset industry. Now, whenever legislation comes up, I think it's important for Bitcoiners to avoid two extremes. The first extreme is believing regulation doesn't matter. The second extreme is believing Bitcoin needs permission. Blocks continue every 10 minutes, regardless of what Congress does. However, businesses absolutely care about regulatory certainty. Custodians care, banks, public companies, pension funds, asset managers, they all care about regulatory certainty. The easier it becomes for institutions to understand the rules of the road, the easier it becomes for capital to enter the ecosystem. One thing I've been thinking about recently is how much the conversation has changed. 5 years ago, the debate was whether governments would ban Bitcoin. Today, the debate is how to regulate an industry that clearly is not going away. That is a significant shift. I continue to believe Bitcoin benefits from clarity, even if it doesn't depend on it. Europe and the future of crypto regulation. So while most Bitcoiners focus on Washington, Europe continues moving forward under MiCA and discussions about future revisions. What I find fascinating is that regulators around the world increasingly view digital assets through a banking lens. They want reporting requirements, capital requirements, compliance requirements, consumer protections. Some of that is understandable. Some of it may eventually become burdensome. The important takeaway for Bitcoiners is that regulation increasingly shapes the rails around Bitcoin rather than Bitcoin itself. The protocol remains neutral. The question is how governments choose to interact with it. I expect this trend to continue. Bitcoin becomes more global, regulation becomes more localized, and users ultimately decide which jurisdictions provide the best balance between innovation and oversight. I'm talking to you, sovereign individual. Privacy technologies continue facing security challenges. This week brought another reminder that privacy technologies remain difficult to build securely. Reports emerged of additional issues surrounding the Aztec ecosystem and related infrastructure. Now, before anyone misunderstands my point, privacy is essential. Privacy is a human right. Financial privacy is important, but privacy systems are often technically complex, and complexity introduces risk. This is one reason I continue to appreciate Bitcoin's conservative development culture. Bitcoin moves slowly, painfully slowly at times, but there is wisdom in that approach. The larger the monetary system becomes, the more expensive mistakes become. One lesson I would offer listeners is this. Don't confuse innovation with robustness. Sometimes the most exciting technology is not the safest technology. Bitcoin's strength increasingly comes from its stability. The global liquidity debate continues. Another recurring theme this week was global liquidity. Many market participants continue debating whether liquidity is tightening, stabilizing, or preparing to expand. This topic matters because Bitcoin has historically responded well to improving liquidity conditions. But I think there is a deeper point. Bitcoin's long-term thesis does not require perpetual liquidity expansion. It only requires monetary debasement over time. And history remains remarkably consistent on that front. Governments borrow, debt accumulates, interest costs rise. Central banks eventually respond. The exact timing is always uncertain. The direction is not. I continue to view Bitcoin as a long duration hedge against that reality. The path may be volatile, the destination remains compelling. Bitcoin continues doing Bitcoin things. For the final story, I just want to zoom out. This week we discussed geopolitical tension, the Federal Reserve, ETF flows, treasury companies, miner stress, regulatory uncertainty, privacy challenges, institutional adoption, and yet here is the remarkable thing. Bitcoin produced blocks every 10 minutes. The network remained operational. Transactions cleared, difficulty adjusted, the monetary policy remained unchanged. No committee voted, no politician intervened, no executive team changed strategy. Bitcoin simply continued functioning. Sometimes the most important story is the one that doesn't make the headlines. Bitcoin's reliability remains one of its most underappreciated features. Now let's move into some of the conversations happening across the broader Bitcoin podcast ecosystem this week. One theme that showed up repeatedly was the growing debate around Bitcoin treasury companies. Several excellent discussions explored whether these firms represent the next phase of adoption or whether investors are underestimating leverage and balance sheet risk. This remains one of the most important conversations happening inside Bitcoin today. Another major theme was open source development and digital sovereignty. As governments become more involved in regulating digital assets, the importance of open source infrastructure becomes increasingly clear. Open source software remains one of the strongest defenses against centralization. Several podcasts also spent considerable time discussing stablecoins. I continue to find the stablecoin conversation fascinating. Stablecoins are becoming a tool of dollar expansion globally. Bitcoin remains a neutral monetary asset. The relationship between those two trends will likely define much of the next decade. And finally, builders continue building. Payment infrastructure, merchant adoption, Bitcoin maps, BitAx projects, Lightning tools, self-custody improvements. This activity rarely receives mainstream coverage, but it may ultimately matter more than short-term price movements. Moving right along to this week's featured article on the Bitcoin Fortress Substack, A Bitcoin Way of Life, Week 5, Consumption versus Creation. One of the ideas I explore in that essay is the distinction between consuming and creating. Modern technology has made consumption effortless. We can scroll endlessly, watch endlessly, react endlessly. Creation is harder. Creation requires effort, patience, discipline, focus. The connection to Bitcoin may not be immediately obvious, but I believe it is profound. Fiat systems tend to encourage immediacy. Consume now, borrow now, upgrade now. Bitcoin tends to encourage longer-term thinking. Save, build, create, invest in skills, invest in relationships, invest in yourself. Ultimately, the goal of Bitcoin is not simply wealth accumulation. The goal is creating a better life. If you haven't read Week 5 yet, I encourage you to check it out. Link in the show notes, along with all of the other articles we went over this week. Before we wrap up, I would like to remind everyone about the 4 Bitcoin Fortress books. Bitcoin Fortress, A Simple Guide to Bitcoin for Beginners. Bitcoin Retirement and Estate Planning. I've looked around. I haven't really seen any books that are bespoke that cover this particular topic, so I could be the first one there. The Bitcoin Lifestyle, and my newest book, The Architecture of Money. The Architecture of Money explores the evolution of monetary systems, the incentives that shape them, and why Bitcoin represents one of the most important monetary innovations in modern history. If you enjoy the themes we discuss on this show, I think you'll enjoy the books. As I reflect on the week, one idea keeps coming back to me. The headlines feel chaotic. The financial system feels increasingly fragile. Governments continue accumulating debt. Central banks remain trapped between inflation and growth. Investors chase the next narrative. Yet beneath all of that noise, Bitcoin continues operating exactly as designed. That reliability matters. Trust is becoming increasingly scarce. Bitcoin remains one of the few systems that does not require trust in any particular individual. It requires trust in mathematics, trust in incentives, trust in open source verification. That is a powerful idea. The future will not unfold exactly as any of us expect, but I remain convinced that sound money will continue to matter. Stay humble, stack sats, protect your health, protect your family, protect your privacy, protect your keys, and continue building your Bitcoin fortress. Thanks for listening, and I will see you all next week.